Hey everyone, and welcome back to another portfolio update. As you can see, we are underperforming by quite a lot more recently. Week over week, we are down 1.34% compared to the S&P 500, who's down 0.39%. Overall, since the start of this challenge, we're down 4.5%, which if we compare it, let's say year to date, which is not really year to date because we started a bit later, we are down 4.5%, whereas the S&P 500 is up 6.16%. So yes, extreme underperformance by the portfolio, which makes sense if you look at the positions that dominate the portfolio. Tesla is number one. Tesla is still down over 20% year to date. PayPal hasn't really moved much. Google has been doing the best job in my portfolio. SoFi, not that well. Palantir is relatively new-ish in the portfolio. Adobe is down. Snowflake down. Lululemon down. dLocal down. Meta is still green, but more recently there has been some weakness in the stock, which in my opinion is a great opportunity to add a bit more. I'll accumulate accordingly. Then I'm finishing off here with Intel, Rocket Lab, and Appcelera. Smaller positions, but also not performing as expected right now. Nothing has changed in my thesis in any of these companies. We still have Adobe's earnings report coming up, I believe in 10 days or so. We still have Lululemon's earnings report coming up next week, which is why I'm going to talk a little bit more about Lululemon right now and what we could expect. But overall, yes, I fully acknowledge that right now I'm underperforming by quite a lot. But I do think that if the thesis, in my opinion, the thesis will turn out to be correct, most of these stocks will turn green by the end of this year. Will that mean that I will suddenly outperform the market already right now? Maybe not as much as I would like, but I do think that I'm well positioned for a complete turnaround. Now, before we continue, this is basically what is going to happen next week with regards to the earnings. On Monday, not that many companies report. You've got GitLab and some others. On Tuesday, after the market closes, you've got CrowdStrike and HP Enterprise, then Stitch Fix as well. On Wednesday, before the market opens, nothing really that interesting to be. After the market closes, you've got the big one there. Of course, I'm talking about Victoria's Secret. What did you think? Just kidding. It's Lululemon after the market closes. On Thursday, before the market opens, you've got Neo. And after the market close, you've got DocuSign. That's a company we have not talked about for quite a while, but I do think that the business is doing a bit better than before. Maybe we're going to cover that, but overall, that's what's going to happen in the coming days. And so to start off, I want to talk a little bit about Lululemon, then talk about the software issue, let's say, that's happening right now, or non-issue in my opinion. So let's start off with Lululemon, the expectations and what's going on. So right now, Lululemon is down close to 40% year to date. It's quite clear that valuation-wise, we are now at levels that are cheaper than its 5-year mean, but some might say it's still too expensive for what it is. In my opinion, I don't think it's that expensive. Forward PE 22.1 times, EV to EBITDA 13.2 times, price to sales 3.6 times, price to free cash flow that's in the last 12 months, 23.9 times, price earnings to growth at 1.76. So, in my opinion, not that expensive. If we look at how the business has been performing throughout the years, revenue has grown steadily. Yes, we had a little dip with regards to free cash flow, but that has recovered as well. Return on equity is quite high, 42%. Return on invested capital, 30.6%. So all of that is well and great. Gross profit has grown quite nicely in the last couple of years, and so has net income. So overall, in my opinion, the business is still doing well. Can we expect, or is it experiencing a little bit of weakness? Yes, probably, and probably it was trading also at a premium, so the stock took a breather. The current average analyst price target has come down in the last 3 months, but it's still at $429, representing 37.6% upside from the price we're at today. And so if we look at what the analysts are expecting for the coming fiscal years, basically a bit of the same each and every year. Sales growth of around 10% year over year, EPS growth of around 10%, 11% as well. So that's basically what you get, growing a bit like the market, buying back a bit of shares as well. Now, last quarter, and this is using Brad Freeman's Stock Market Nerd on X little cheat sheet here, which is amazing. The quarter was good, right? They beat on revenue estimates, they beat on GAAP earnings per share, and they beat on GAAP gross profit margin as well. The problem here, again, is always guidance. So they missed revenue estimate guidance by 1.7%, and missed EPS estimates by 16 cents or 1%, and they reiterated their 2026 targets. So again, to me, it's a repricing of the stock that was maybe going up a bit too fast. The business did not follow that as fast as you would expect, which is fine. As long as the long-term thesis, as long as the long-term trajectory of this business continues to be intact, I don't see any reason to sell. And so while I'm down right now 14% on that position, I'm in no rush to start selling right now. The current expectations for the coming earnings report is that EPS on a non-GAAP basis to come in at $2.4, EPS on a GAAP basis $2.42, revenue estimates $2.2 billion. There were just one positive EPS revision in the last 90 days and 17 negative ones. And so looking at the graph right now, the stock has been oversold in the last week or two. Right now, we're just not oversold. So maybe that point here at around $300 is the rebound area where we've seen the stock rebound before. Of course, with earnings coming up, you can expect some volatility in that stock on the up or downside. Now, before talking about the software issue that we might experience right now, just on Snowflake, Palantir, what happened with Salesforce, etc. By the way, this Salesforce video is going to be in the top right corner. I do want to talk quickly about NIO, XPeng, and all the other Chinese EV makers. So Chinese EV maker NIO announced Saturday that it has recorded over a 200% year-over-year increase in vehicle deliveries for May 2024, a substantial growth compared to its peer XPeng and Li Auto. Shanghai-based NIO delivered 20,544 vehicles for the month, indicating over 234% year-over-year growth. Meanwhile, XPeng and Li Auto trailed with 10,146 and 35,200 deliveries, respectively, which implied around 35% year-over-year and 24% year-over-year growth. NIO May deliveries comprised of 12,164 premium smart electric SUVs and 8,380 premium smart electric sedans, and its cumulatively delivery figure stood at 515,811 as of May 31st. Meanwhile, XPeng said its year-to-date deliveries of smart EVs reached 41,360, implying around 26% year-over-year growth. As for Li Auto, cumulative deliveries stood at 774,571, including more than 15,000 units of its newly launched Li L6S, which started commercial deliveries on April 24. So for all of you Chinese vehicle owners, that's a positive update. By the way, this is on Seeking Alpha. Link is down in the description below if you want to help yourself out and myself. Now let's talk a little bit about the software issue, right? Salesforce reported their quarterly numbers, Salesforce crashed, but took every other software maker or software player, should I say, with it, right? Snowflake went down. Snowflake is now at $136. It's down 16.8% the last month, so quite the underperformance. Me specifically, in my position, I'm down close to 20%, but it's not the only one that went down. Palantir is also down. Actually, it's also down 14% in the last month, but in the last week, you can also see that the stock dipped a little bit after Salesforce reported their quarterly numbers, and plenty of other companies as well. So what's the big issue? Well, the big issue is that some analysts, some people believe that AI will basically destroy these types of software companies. More specifically, they will destroy the likes of Salesforce. Why is that? Well, because companies like Salesforce, not just Salesforce, but companies like Salesforce, their business model is basically based on, well, other companies using their products and them hiring more and more employees, which means they're going to pay per seat, which means more money flowing into Salesforce. Now, with AI capabilities and all of that, you're making basically companies more efficient, right? We've been talking about that for quite a while. Doing more with less. So obviously, for a lot of SaaS companies, that's not great. That means that you will be selling your software to less people. Not great. But the one point I do not agree with is that it will destroy companies like Salesforce. It might destroy smaller ones, 100%. Smaller ones that just exist because of the zero interest rate environment. But a company like Salesforce, I don't think that will disappear because of AI. I think a company like Salesforce will also become more profitable, more efficient, thanks to AI. And by the way, how many technological revolutions have happened in the last 2 decades or so, right? You've got the internet, you've got the mobile phones, smartphones, iPads, digital stuff, VR, AR, cloud-based technologies, etc., etc. All of that, what have they done? They've not destroyed all the jobs. No, actually, thanks to all of those new technologies, we've created more jobs. More jobs exist thanks to the internet. More companies exist thanks to cloud companies, cloud computing, right? Like I said, it makes things easier, which means it makes it easier for you to create your own company as well and actually become quite competitive in this day and age. So to say that AI is going to ruin these types of companies, in my opinion, is a bit, I would say, lazy thinking. Like I said, it might destroy smaller companies, but I don't think that companies like Salesforce, like Snowflake or Palantir or Datadog or all of that will get hurt because of AI. Plenty of those companies actually will make it and will become way bigger because of AI, or should I say thanks to AI. You might disagree, that's just my opinion, of course. Share your thoughts down in the comment section below. Now, with regards to the rest here, PayPal, we've talked about. SoFi, nothing has changed. While the stock might be down, 3.6% in the last months. Year to date, it's down 30%. Since the last time I talked about SoFi, nothing much has changed. The stock hasn't moved that much, but I know some people will make fun of the SoFi holders, myself included. Oh, bag holders, why aren't you talking about SoFi? If there's nothing to talk about, I will just not cover it. I'm still having the same sentiment, the same thesis, in my opinion. Under $7, at $7, I think it will be worth way more in the future. That's all. With regards to Adobe, we've talked about Adobe in actually Sunday's video, depending on when you're watching this. I think it's an underrated company and one of those companies that again has the AI will destroy that company type of sentiment. In my opinion, AI will just make that company become more efficient and actually more powerful as well. Other than that, on the watch list, I've added Duolingo when it was at $179. Never really covered that, and now it's at $191. So, okay. I believe the stock crashed because of OpenAI's demo, where they talked in English and in Italian, etc., etc. So that might challenge Duolingo. If you want a video on that, let me know down in the comment section below. I've talked about Sport Radar on the channel already, and I'm yet to cover Genius Sport Limited. It's a bit of the same player, basically playing in the same industry. Very, very interesting companies. Alibaba went close to $90 or at $90. Now it's back under 80. So maybe it will become, again, a small trade position. Remains to be seen. Build-A-Bear is still on the watch list. Very, very interesting company, also flying under the radar. And so to conclude, the portfolio obviously is not performing that well. Obviously, it makes sense since the holdings that dominate the portfolio have not been performing well year to date. That's fine. The thesis hasn't changed. It won't change just because the stock is red. Now, I know some people will say, oh, you're underperforming the market. I'm only doing this since end of February. I don't think any long-term investor looks at its track record for the last 3-4 months or so. Yes, I know I could have bought SMCI or Nvidia or Microsoft or any other of those stocks. Yes, I could have. But I rather go now with stocks that are nowhere near their all-time highs, that are flying under the radar, that everybody hates, that there's a lot of noise surrounding them, and still perform well as a business, because eventually the stock will follow that. So in the meantime, all the short-term clowns, they can make fun of me. That's completely fine. That's why I'm here, right? That's why we're here. Anyways, overall, that's about it. We will cover NIO, Lululemon, maybe DocuSign, CrowdStrike in the coming days, and then some other videos as well. So stay tuned for that. Do share your thoughts down in the comment section below. And as always, hit the subscribe button, the bell notification, like it, do everything. And I'll see you all in the next one. Bye-bye.